Every trading guru, which I am not, will at some point in their lives, on their careers, on social medias, will spew the words, you gotta journal your trades. Now, whether they actually journal your trades, they actually believe that, or it's just an extra thing or a piece of content that they can put out so they can sucker you in to buy something from them, it doesn't matter. That's irrelevant. But what is relevant is that journaling trades actually can help you. And it actually, in theory, should help you in your own trading. And there's not really a debate about that. I mean, how can you come in and debate the fact that if you were to journal your past 100 trades and glaringly see that I double down and all the times I double down, I lose more, and then just eliminate doubling down on losers, you'd save yourself some money, which then means you don't have to make as much on the upside to be green, right? So it's not like that wild of a thought, in my opinion, that journaling trades is good and it can help you. But over the past couple of years, I have journaled trades. Really since 2019, I started making lists and stuff on and off. It's really the past 8+ months, 8-ish months, that I have taken it a lot more seriously and been tracking and journaling every single day. So as someone who has done so for some time, I want to go over 3 of the biggest keys to journaling effectively that can help get you into a pretty good spot so that you are actually taking away what needs to be taken away from your trading mistakes, your wins, your losses, no matter what. The first thing that I want to get into is one setup at a time. When I get into one setup at a time, I mean this as in track one thing at a time. Like, I used to go back a year, not even that long ago, I had 17 different setups. And it was December. I had a really good month. And I was trading a bunch of different stuff, whether it was VWAP bounces, VWAP rejections, breakouts, breakdowns, like this opening gap, like all these different things, day trades only. And you can still track swing trades. There's nothing wrong. It's just, I have to have some sort of criteria for why you get in and what the setup is and all that stuff. But it was so complicated. And I was journaling that, but I realized quickly by the end of the year, I was like, actually it was not until early 2023 at this point, that, it was like, I am journaling. I'm doing what I think I should be doing, but is it effective? Like, what's actually happening here? Am I getting anywhere? Well, I can't, because if I have 17 setups, and I had a list of 10 setups that I would tag on my trades. And when I had this list, I'm like, in a given month, I might take 20, 30, 50 maybe trades max-ish, something like that, if I took a lot. And out of that 50, there might be 3 of this setup, there might be 6 of this setup, might be 8 of this setup. There's just not a lot of consistency in what I'm doing. And so it's very difficult. You'll have to have years, realistically, months to years, to be able to get anything actionable, I think, out of that. Maybe you can start to say, after a couple months, there's something that can be taken away. I can probably get rid of this setup. It's not that good. But it takes time. It's going to take a lot longer, right? So if you stick to one setup, you're going to be able to figure out inside of that one setup what's working, what's not. And the reality is, I think a lot of us will recognize this if you've been around for a long enough period of time. It's not the strategy. It's not the setup. It's how you react to the setup. You could trade breakouts. You could trade dip buys. You could trade 17 different things. Well, first off, we need a gap up. Then we need a fair value gap. We need a break of structure. Then we need a fair value gap. We got to fill that gap. Then we got to short it. And you could do that too, as long as you got a strategy. You've got some sort of systematic approach to it. There's nothing wrong with that. But reality is that if you are tracking and journaling your trades with one setup at a time for a standard, or let's say a longer period of time, weeks, months, to get yourself 50, maybe even more data points to go off of, you're going to be able to really analyze that strategy and then get to the root of trading and root of journaling. And that's you and how you react, what you are good at, what your pitfalls are, your problems. That's what you want to get to the bottom of faster. And you can't do that when you're trading 17 different things. You're going to be too confused and you're not going to get there fast enough. I know for me, I want to give my strategy, and this might be a long time for some, I want to give it a full year plus. When I try a new strategy out, of actually tracking. If I, at the end of a year, I have a lot of data to go off of. There might be some great stuff in there. It might be profitable. It might not be profitable. But at the end of a year, just because it's profitable or not does not make or break the strategy. It then gives me a really good piece of data to go off and say, okay, now I've got a ton of data. Now, how do I make this better? How do I make this work better? Now, the next piece, part 2, is patience. And I don't mean this in like, oh, don't take too much or be patient for the setup. Like, I do and I don't. It's not that like you need to be patient, trade the setup, don't get FOMO. Like, yeah, okay, all that's aside, right? In journaling, being patient, I think, is very important, because what I then started to do was, okay, I'm trading one setup. Well, how do I get this data faster? Go back to when I started trading the strategy, and to get data faster, I was trying to take as many trades as possible. What's the problem? How many of those trades are actually good quality? And how many are shit quality? And so you now have a bunch of shit data that you're going off of. You don't have actual good data to go off of if you're trading stuff that like meets 3 out of the 4 criteria, meets 1 out of the 2 criteria. You're not getting quality data. So be patient. When the setup triggers, you take it. If it doesn't trigger, you don't take it. There's no need to rush to get in, just to get the data, then to go back and say, I don't really care if it's going to win or lose. I just want to get the data so that I can come back and then try again next time with a better approach, with more information, and with a better understanding of what to do, what not to do. Well, you're going to have done that off of terrible data or trades that maybe don't even fit your strategy. That's not really going to help, right? So patience is key in that regard. The market will be open tomorrow, the next day, the next day, the next week, the next month, the next year, and maybe think it's not going anywhere. There'll be plenty of opportunities. Number 3, analyze and implement. This is obviously like the biggest piece. So how do we go ahead and analyze and implement? Well, we need to learn how to cut the fat. To be able to cut the fat, we have to identify the fat. And so what could be an example of the fat? Now, some will say that fat's good, some will say it's bad, some like cutting it, some don't, some just eat the whole steak no matter what. But at the end of the day, if we can cut the fat to have a nice lean strategy, we're going to probably save time, we're probably going to save money, we're probably going to save mental energy, and we're going to have a strategy that's more effective, that's getting us our protein, that we get in, we get out, and we don't have to sit here and go through a lot of the ups and downs that we would of having to digest some of the fat. We're looking for consistency in the data. Monthly, ideally, weekly if you trade a lot. And what I mean by that is, personally, I look at this every month. Every month I take inventory and I go, okay, what has happened this past month with the strategy? Like, what's going on? And maybe on a given month, you're recognizing that double down approach, right? Where you're like, hey, on losing trades, I tend to average down. And on average, or I guess that's maybe not the best way to phrase it, more often than not, which I'll get to that into more of an explanation there in a second, those trades lose. So if more often than not they're losing, I'm going to stop doing that, right? And so now that's me realizing that averaging down has led to bigger losses. How do I avoid the bigger losses? Boom, let's stop averaging down. Eliminate that. That's going to save me a little bit. It might not make me green, but it could save me at least a little bit on the back end, get some of that water overboard of a sinking ship. Now, I kind of got into this probability mindset, and of course, you probably heard probabilities, trading, yes, no shit. But when it comes to probabilities, I mean, like, hey, if I go back through my data and I realize that by simply stopping out at VWAP, let's just say on an example trade, right, whether we're above or below, we get back to VWAP, I'm going to stop out. Stopping out at VWAP if I'm playing momentum, stopping out there saves me, because then it tends to be a smaller stop loss than my usual, I don't know, 10%, 20%, or whatever percentage, or whatever dollar amount based on your sizing. That's all going to vary. Then that is something that I might consider. And if I recognize that all of my trades that stop out end up crossing VWAP before they hit my stop, or let's say 85% of them, or even 65%, more often than not, the VWAP is an indicator that this trade's not going to work. So let me actually move my stop to VWAP, and now I'm going to save myself a little piece on every losing trade that happens to cross VWAP. And so that's one of those ways, or that's one of those things personally that I view as like, hey, there's a higher probability of this going to be a loser if I let this thing go even further, or if I let this thing go past this line or this point. I'm going to stop out at this point. I know there are going to be scenarios where it's going to go back above VWAP, cross it, and then come back in my direction and go to my take profits. But that only happens 10, 20% of the time. I might see that happen and go, oh my gosh, it can happen. But I have to recognize through the data, it's not a high probability situation. And I'm better off long-term stopping at the VWAP, for example. Now, you'll need a place to go ahead and track and analyze. There's a lot of ways to go ahead and do this, but there's really kind of a key pillars of tracking. And that is your win rate, your average win-loss, and then your profitability. So your like P&L or profit factor, if you will. And your average win-loss is simple. It's a simple calculation. It's kind of like a ratio. If you have a winner of $100, then you have a loser of 75. Your average winner is 100, your average loser is 75. You can then divide 100 by 75. Boom, you got a number. As long as it's over 1, you're good to go, or at least in theory, you'd be good to go with a positive or a 50% or better win rate. Win rate, again, something to track, and then profitability is kind of like the summation of those two. Are you actually green or not? Take all of your losses, all of your wins. Where are you? And then make that ratio as well. Once you can track all of those things, you're in a good spot. And then beyond that, it comes down to you actually taking note of what's happening with your trades, tracking setups, tracking things like day of week, if that's something you want to track, tracking things like time of day that you're trading, if it's something you want to track. Again, not going back to the first point, like you don't have to track everything at the same time, but one at a time. And then so when you're analyzing and implementing, do you want to go out and just try to do it all at the same time? So for example, I'm going to move my stop loss. I'm not going to trade on Fridays because I know Fridays I lose more often than not. I'm only going to trade during power hour because everything else I tend to be more red. And I'm never going to trade during the Fed meetings. And you start having all of these different things one at a time. If you can fix one, maybe that next week or that next month, you see some noticeable changes. Then you realize, okay, what else is holding me back? What other fat can I cut off, right? Cut that off, boom. It's these little adjustments over time that start to stack up and they compound, like anything else, they compound in your trading. And that's what it's all about. I personally use TradeZella. I will leave a link to that below. It's not sponsored by TradeZella. That's one of the platforms I use. I've used a bunch. I have nothing against other ones. Personally, TradeZella is super easy for me to track. It is expensive, but I find value in using it because of how easy and what they give me in terms of what I see, visualize. There's some videos back on the channel about TradeZella if you want to go back and check them out. And there should be a playlist as well on TradeZella. But I'm able to kind of put everything in, track it, tag it, and then quickly get some great data at the end of a week or even the day once I have a couple trades in there that I can easily analyze and then figure out where the fat is that I got to cut out. That's just one option. I'll leave links to any resources that I use below this video in the video description box. But outside of that, hopefully this video is helpful. Those are my 3 keys to journaling trades. If you want me to go deeper in the future, there's definitely offshoots to this video, but I think that from a starting point, if you can get this under control, you're going to be in a pretty good spot to now continue journaling. Journaling becomes kind of second nature, and then it actually becomes something useful and helpful in your own trading at the end of the day, which is the goal, right? That's the goal. Hope that was helpful. Thanks so much. I'll see you guys in the next one. Thumbs up button, consider subscribing. Peace.